Hello, everybody. Welcome to today's webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Our webinar title today is When Do Investors Sell a Stock? My name is Shen Chu. I'm the moderator for this session. Now, buying stocks is often a logical process where we go through a methodology, for us to arrive at the buying decisions, so that when we can make an informed investment decisions. But every time when it comes to selling a stock, it often involves many emotions, right? It involves regrets, it involves fear, So when should investors sell a stock, right? So today we have invited the co-founder of Dividend Vault to share with us his methodology when it comes to selling a stock. Now, disclaimer, whatever we share in this session is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decision, you're 100% responsible for all your investment risk. Allow me to briefly introduce our speaker today. So Mr. Ian Tai is the content producer on kclove.com, where he has written over 300 articles on kclove.com and also a regular webinar host and presenter on it. He is also the co-founder of Dividend Vault, where he transformed newbies into investors who can build dividend portfolios independently via education. He himself is a dividend investor where he yield on average 2 to 12% dividend yield per annum. So that's his track record. So Ian, good to see you here today.
Hello, Shane. Hello, everybody. Good evening to all of you.
Yep,
Once again,
good evening.
great introduction. Thank you so much. And it's always a privilege to be here with you, Shane. And of course, on the platform of Bursa Malaysia to actually share my journey as a investor. All right. So today I have actually prepared a lot of materials. So let me just quickly share with you my screen so that you can actually get ahead with it. All right. So guys, I mean to say, if you have any questions along the way, feel free to just post your questions in the Q&A box. I'll be more than happy to address them right after this session. Okay. So here we go. Today, I will be sharing with you 5 situations I think that investors would be selling a stock. Okay. So which means to say, in this 1 hour, right, the whole objective of this 1 hour is to actually fill in the boxes. Okay. So we have box number 1, which represents situation number 1, situation number 2, 3, 4, and 5. Okay. So basically, there are 5 situations where investors, including myself, would be selling a stock. Okay. So before I proceed, just want to hear from you guys, from the audience. When do you suppose you will be selling a stock? All right. So maybe you can type in the chat box, and maybe Shane, you can share with us what is the feedback from the floor when it comes to selling a stock. So guys, type in the chat box. When do you suppose you will be selling your own stock? Just want to get a feel of our audience today. So Shane, are there any respondees?
Yes, when we hit TP, that's when we sell stocks. Okay, good news. Some say, when many retailers enter the market, that's when I sell. Okay. Or when there's rumor, that's when I sell. Right. That's what I see. When I need to cut loss, that's when I sell. Okay. When is business fundamental change, that's when I sell. Okay. So yeah, I think many of them, many of the responses I see is when the price goes up, that's when I sell.
Okay, fantastic. So all kinds of responses, very, very different reasons. I believe that is actually the case simply because each and every single one of us here today are very different individuals. So we will actually invest very differently based on our own criteria, based on our perception, our beliefs, our mindset when it comes to investing. And in fact, I mean to say for this whole webinar series, right, this whole webinar session, today I will be talking in the context of an investor simply because I'm not a trader. I'm not a speculator. So if you happen to be a trader or speculator, so this content might not be suitable for that sort of things because I have no experiences when it comes to trading stocks or speculating and all this kind of stuff. All right. So this is actually pure investing content. All right. So without further ado, let me just begin. And I would like to begin by first introducing to all of you guys on the methodology of how I build my own personal stock portfolio. I believe this is important because if you know the context behind how I personally build, what is the system behind, what are the things that I'm actually more, how do I say, what are the things that I place more emphasis to build, know why I would probably sell stock. Okay, so here is how I actually build my own stock portfolio. So let me give you a quick tour of my own portfolio. So question number one, what do I exactly buy? So these are my stocks. So um I have concealed the actual identity of the stock. Okay, but these numbers are actually real. So these are my top 5 holdings: stock A, stock B, stock C, stock D, and stock E. So all these are actual earnings. Okay, so what I do as an investor is to buy businesses that are highly profitable. Okay, so which means to say, when it comes to their fundamentals, right, I make sure that most of the stocks that I buy, when it comes to their earnings pattern over the long term, it will look something like that. It is always one way line. It's always a one-way track where I consistently have to grow over the long term. Okay, so I don't just look at things. I don't assess the stock's fundamentals in 1 year or 2 years. I always tend to actually look at it at a much longer horizon, whereby it's always multi-year. Okay, it's always multi-year. As you can see, I look all the way back 5 years, 10 years, actually 10 years lah, to be exact. I don't even look at things at 5 years. I just want to see the track record of the company that I buy, whether or not it has delivered consistent growth in profits. So all my stocks, when it comes to their earnings, right, it will look something like this. All right. So what do I buy? I buy highly profitable businesses. Okay, so that is actually my style. I don't have any other things that is, except for one lah, but that is actually an exception. Maybe Harta Lega lah. Okay, so I do have some Harta Lega, but that one, right, is either break even or loss. I do not know how you want to consider that. So I will give that an exception. But as for the rest of the stock, when it comes to the earnings pattern, it looks something like this. Okay. Next. So the first question is, what do I buy? So I buy highly profitable businesses. So that is actually the things that I'm interested to buy. Okay. Now the question is, the next question would be, when do I buy? Okay. Now, this is actually a chart based on my actual transaction. So as you can see here, this is actually a simple chart on PE ratio, or should I say the initial PE ratio. So what do I mean by initial PE ratio? Initial PE ratio is a PE ratio at the date when I actually transacted or invested in the stock. So which means to say, if let's say I bought a stock maybe 3 years ago, it is actually the PE ratio of that stock 3 years ago. Okay, so that is called initial PE ratio. So this is a scale between 0 all the way up to 20. Okay, and in the middle, we have a PE ratio of 10. So as you can see, these are the stocks that I personally invested, and their PE ratio, right, are mostly somewhere congregating around here, where the middle ground is actually 10. So I do have some stocks where I have invested in them at a PE ratio below 10. So this is actually somewhere around 7, maybe 8 point something. So I do have some stocks whereby I purchased them when their PE ratio or their initial PE ratio is actually somewhere around 7 or 8. Then I do have some other stocks whereby I purchased them or should I say I invested in them when their initial PE ratio is around 11, 12, or 13. And of course, I do have two exception stocks, whereby I bought them at above 15. So maybe this is about 16, this is about 17. So overall, I have made my transactions over here. Okay, so this would be it. Do I have any stocks that go beyond 20? Currently, I do not have. I do not actually buy any stock at this point in time where their PE ratio is above 20, above 30, above 40 or 50. So I don't have that kind of crazy stuff. All right. I only have something which is more, how should I say, when it comes to PE ratio, it's a little bit more sensible, which is a little bit more rational, which is somewhere in between, in the tens. Okay. So one thing is for sure, when I buy a stock, I may not actually calculate how much will I be getting from the stock. That's not my concern. My concern is that whatever stock I buy, when it comes to managing my portfolio, I make sure that the overall PE ratio of my entire portfolio is actually as low as possible. So when you have a very low PE ratio, actually you're not too concerned about the downside of things because you kind of like buy a lot of stocks. And remember, I tend to buy this kind of stocks only, highly profitable businesses, businesses that are fundamentally solid. I tend to buy all these stocks and their PE ratio, I make sure that I buy it low. Okay. So it fulfills two parts of the equation already. One, I strive to buy good. Number two, I strive to buy them when they're undervalued. So that is actually my PE ratio. All right, in the chart form, in the scale form. Okay. Now let's look at my initial dividend yields. So this is again a scale between 0 to 10%. So anything above 10%, it's 12, 15%. That is actually nuts already. That's actually quite unreasonable. I won't be expecting a stock to pay me about 15, 20% when I first bought them. Okay. Typically, I would say that when it comes to dividend yields for the first year itself, it will be between around 4 to 6% lah. So somewhere in between will be 5%. So these are the stocks that I have purchased. Okay. And as you can see, most of them actually congregate over here, which is at around 5% over here. We have some 6 and maybe some 7 over here. So 5, 6, 7% dividend yields. Initial dividend yields is something that I tend to aim for. And of course, I do have some exceptions whereby I have one that is actually paying me less than 3%. And I do have some stocks that are paying me 4%. Now, with that being said, just now I mentioned about Hatta Lega. Hatta Lega did not pay me any dividends. But if you have been following the news, of course, something happened and Hatta Lega went up, right? So that's another story by itself. So I have only that one outlier. The rest of the thing, I tend to actually follow the rule book, as you can say. So this is actually the initial dividend yields of my entire portfolio I buy. Now, I won't actually review to you the actual size of my portfolio, but what I can do is that I can actually show you a breakdown of my own portfolio. I won't review the names here, but typically speaking, currently I have about 16 or 17 stocks. I believe it's 17. So we have stock A all the way to stock O, and these are the actual weightages of my stock portfolio as of April 2024 when I do my monthly accounting, my monthly bookkeeping. So I haven't done it from May, so this is actually the latest April 2024. So this is the breakdown of my stock portfolio. So I have about 17 stocks currently, and the largest holding that I have accounted for 14.8% of my entire portfolio. Okay. So this is my biggest stock, 14 point for 12.6% of my stock portfolio. stock N 11.5. So I only have 3 stocks which are above the 10% mark. The rest is 8.7, 8.4, 5.9, 7, and then in the sevens, and then the rest is below 5. Okay. So when you have a stock portfolio like this, actually, I don't really, when it comes to the ups and downs in the stock market, once you go beyond 10 stocks, actually, the ups and downs in the stock market does not really matter anymore, lah. Simply because you have such a diversified, a little, because my portfolio is kind of diversified already. So in a way, the ups and downs in the stock market is just everyday life lah. It's just parts and parcel of building a portfolio. It's nothing to be excited or depressed about lah. Okay, so that is actually my portfolio in terms of a donut chart like this. I think above 15% of my entire portfolio at this point in time. Okay, next, what is my objective? So just now I have reviewed to you, what do I buy? When do I buy? How much do I buy? Now I'm going to share with you my personal objective of building my own portfolio. Okay, so now there are two different mentalities. So I'm going to go a little bit slow here just to explain to you my philosophy or my aim when it comes to building my own portfolio. So of course, there are people who will be into trading, or they have a so a trading mindset. I would say is one who actually when they buy the stock, actually they are not genuinely want to own the stock for life. Okay, so which means to say whatever stock they picked, let's say it's at $1, $2, $5, at $10, it doesn't really matter what the stock is or what the price is. Okay, because anyway, they are not going to hold on to the stock. They are not actually interested to hold on to the stock for their entire life, right? So what exactly they're aiming for is to buy a stock, hold it for a while, okay? Hopefully that a while, whatever time period they hold on to the stock, it's like milliseconds, seconds, having your returns in that scope, then of course you are trading lah, all right? So what they are interested to do is to actually like, you know, try to make some short-term profit buy and when you sell. So if you happen to buy a stock at $1 and you sell it for $1.10, you'll be very happy. $1.30, $1.50, $2, $3. As long as you can actually sell it for a profit and you can actually do that on a consistent basis, then you'll be happy. However, if let's say you buy a stock and it's kind of a wrong bet, and it kind of like dropped to 90 cents, 70 cents, 50 cents, then of course you're not so happy lah. All right. So all in all, whoever is actually in this category, that's not what I'm doing. All right. I don't do this kind of stuff. So that is actually not me. Okay. Whereas on the right-hand side of the screen, so I have a mindset where it is actually more towards accumulation. So which means I don't really measure my returns, like as in, oh, I buy a $1, I sell it for $2, that's 100% return. No, I don't actually do that. I don't actually measure my success that way. So what I do personally is to create a portfolio whereby I just like to own a collection of businesses. Okay. Any kind of businesses, as I'm not biased as to like, oh, I only focus on tech. Oh, I only focus on REIT. I'm focused on bank or something like that. As long as the business is good, it makes sense for me to own them, I will just buy. All right. As long as as long as the businesses can deliver be more than it. If the price, PE ratio is right, the dividend yields are right, I'm more than happy to actually invest in them and hold on to them. Okay. So I like to see myself as a collector of businesses. It can be different kinds of businesses. All right. So for me, my aim, my method of measuring success is to see after I have invested for 5 years or 10 years, multiply by, let's say, the dividend yields, let's say 5% per annum, and then I'll get my annual dividends. Let's say if it's a $100,000 portfolio times 5%, that would be $5,000 per annum. Then that's also a success. If it's 200,000, then a 5% dividend yield will give me about 10,000 ringgit. So if I can actually get my 10,000 ringgit per annum without me doing anything, hands-free, all right, no need to do trading, no need to monitor the stock market every day, I'm cool with that. I think that is actually, to me, success. All right. So I guess different people will define success very differently. But for this presentation, for this sharing session, I believe that it's important for me to share with you guys what is my metric of success so that you get to know me a little bit better. And from there, we will actually go into the 5 situations of when I would actually sell a stock. All right. So that is actually the build up lah. So I would say that whatever I've shared with you just now, the metric of success, how I invest, how I build my portfolio, how I do things right, will be the foundation block to know when exactly I will sell a stock. Okay. So with that being said, let me just share with you something which is very important. Because I see myself as an accumulator of businesses, which means that I buy, I keep. When I buy a stock, I really have I'm genuine lah. Or I will say that I believe that I'm genuine. I'm sincere to actually buy the stock and hold on to it and hold on to it for as long as I possibly can. So that's just me. All right. So it's not so much about trading the stock away for short-term profits and all this kind of stuff. So because of that mindset, usually right, I don't really sell stocks. I do sell, but not very often. So uh, uh, um, let's say for example, stocks, I some stocks, and I don't buy very often. Actually, sell one stock. Maybe I sold one. Maybe I sold two, but that's about it. So which means to say, if you are really an investor, you really want to accumulate and build your portfolio, you tend not to sell your stocks. You seldom sell your stocks. Buying to sell is not the mentality because your aim is to buy and keep. Okay. So that is actually how I do things with my portfolio. Okay. So now I come to the part when exactly I sell a stock. All right. So right now I'm going to just share with you because of my background and how I do things, the way I run things. I'm going to just share with you very quickly the 5 situations that I would probably sell a stock. So situation number 1, personal reasons. So just now in the chat box, someone actually said, you know what? When I'm short of money, then I will sell a stock. Yeah, that is actually part. I believe this lack of money is actually part of reason number 1, which is personal reasons. Okay. So personal reasons, I would say that it is one that how I say, you sell a stock not because of not because the fundamental of the business is bad. It has nothing to do. The reason for you selling the stock has nothing to do with the stock itself. Okay, you just sell the stock because you needed the money for something else. So that's called, so whatever reason that is, that would be under personal reasons. What are some of the examples of personal reasons? Let's take a look. So sometimes in life, I mean, there are times in life where we will go through, They are live events. For example, buying a house. Okay, so if you have a stock portfolio and then you are short by $10,000, $20,000 to actually put down as a down payment, or maybe you want to pay your legal fees, then you sell off your stock, fine. So that's actually personal reasons. It has nothing to do with the stock. Or some of you guys, including myself, just got married. So you want to fund your wedding ceremony. So you cash out a little bit of your stock portfolio to fund your wedding ceremony. So that's perfectly fine. Okay. Education. This could be parents funding their kids' tertiary education. So it's perfectly fine. If you want to actually liquidate some of the stocks to pay school fees or university fees for your children. Business pursuits. This could be a situation where you're a very good business person, you have a stock portfolio, however, you are looking to embark on a new business project, or your business is actually facing some form of difficulty, and that leaves you no choice but to liquidate some stocks in order to keep your business afloat, then you have to sell your stock lah. All right. No problems with that. And also we have other emergencies. So this could be medical emergencies or any other emergencies that you can actually think of. All right. So any of the 5 reasons here, these are all personal reasons. It has nothing to do with the stock's business fundamentals. Okay. So that's reason number 1. Now let's do reason number 2. Reason number 2 would be deteriorating fundamentals. This is actually the more serious. This is a point for any investors to sell off a stock. Okay, so if let's say the fundamentals of the stock become bad, then of course we sell off the stock. All right, so let me give you an example. So this is actually a real case study, a real stock listed on Bursa Malaysia. I conceal its true identity, all right? But there is a stock which is called A Berhad, like this. And let's say you are an let's say I'm an investor and I look into the company's reports and I find that the net profits of this company has been growing like this. Then I say, hey, since A Berhad is actually a company that has delivered consistent growth in profits over the long term, I will be more than interested, more than happy to actually buy into this stock, okay, and hold it for the long term, okay? Simply because we want to actually invest in a company that has the ability to grow we want to invest in a company that has the track record to grow its profits in the past. And since it has a track record of growing its profits in the past, it has a better chance of growing its profits in the future. And let's assume that I have done my due diligence and I'm willing to invest my money and buy A Berhad shares. Let's assume, all right? Now, this is actually the net profit figures before investing. As you can see, profits are rising. However, after I have invested in it, which is here, the next few years, as you can see, the profits generated by A Berhad has been declining. All right, so it was at 149.1 million ringgit. Then it dropped to 117. It climbed back to 129. This I think is okay. Then subsequently it dropped to 103 and eventually 73. Okay, so which means to say from here to here, it seems that the profits has dropped by 50%. So profits in this sense had declined. And let's assume that after we investigate, we couldn't find any justification of why exactly this business has actually reported such profits. Okay. So now at this junction, it is very important for investors to look at the objective and say, do I want to keep it? All right. Because these things, before you buy, profits go up like this. After you buy, profits actually slow down or profits actually decline. It does happen, but not very often, but it does happen. So when it happens, we have to actually reassess the fundamentals of the company and see whether this is actually a permanent situation or a temporary one. If this is actually a permanent situation, it's time to cut loss and say goodbye to this stock. Okay, it's just as simple as that. If this happens during normal business conditions, without COVID-19, without external market forces, it's time to actually exit your position and cut your losses from A Berhad. However, if let's say the decline in profits is due to COVID-19, let's say, for example, you buy into a retail company and the company couldn't do business simply because it's MCO. Nobody is allowed to actually open their doors and do business. Then, of course, that is actually called abnormal business condition. So that one, you can give it a pass. You still can actually justify it with this kind of reasons. But if this is actually happening during normal business circumstances, then very sorry. It's time to actually say goodbye to this stock. Okay. So the second reason, which is deteriorating fundamentals of the stock, is a more concerning reason for selling a stock. Okay. So this is actually a very important reason for selling off the stock. First reason, hopefully it won't happen, but this one is actually something which is cannot be controlled lah. It's all very much individual basis, right? It's all depending on the individual circumstances. Hard to control. This one, if this thing happen, it's time to assess objectively. And if let's say this is actually a permanent situation, time to move on. Next, let's talk about wrong valuation. Okay, so here's another case study. Wrong valuation. How does it happen? Now, there is another stock listed on Bursa Malaysia. So this is what happened. When it comes to the profits, take a look at the earnings. Earnings have increased steadily, or you can even say rapidly. The earnings of the company has increased from 210 million ringgit in 2017 to 300, then eventually 400, and eventually in 2023, it has actually generated 560.8 million ringgit. So in other words, you can say that when it comes to business, the profits made has increased by 2.7 times, all right, over the past 1, 2, 3, 4, 5, 6 years. In 6 years' time, it has actually more than doubled, 2.7 times its profits. So in terms of its business fundamentals, it's pretty okay. However, when it comes to its stock price, you can see that it has risen a bit, and then for the longest period of time, it has actually declined. As a matter of fact, if you look at, so this is obviously from Google Finance, and if you look at the stock price, it has actually risen all the way up to $2.80-ish kind of stuff. Eventually, it dropped by 47% to $1.50. So what is going on? Why do this stock, a real stock in Bursa Malaysia, profits go up by 2.7 times, but stock price keep on tumbling down? Why? What's the root cause of all this? The answer, simple, valuation. Let me show you. A lot of people look at valuation just based on whatever is being presented on Google Finance, the stock chart. Actually, for investors, we have to look beyond the stock chart. Okay, we have to look at the stocks. We have to value the stock, not just look at the stock price. So let me take you a tour on this stock over here, which is an actual stock listed on Bursa Malaysia. And let me show you the PE ratio, the behind the scenes when it comes to this stock, all right, for the stock price that has been presented on Google Finance. Let's take a look. So earnings has increased, but if I calculate the PE ratio for this stock, so over here in 2020, the PE ratio, the PE ratio over here is 58.1. Okay, 58.1. Over here, the PE ratio is 52.5. Here, I didn't calculate here, but I suppose it's way beyond 50. It's gonna be 60 or 70. So it depends on what is the PE, what is the earnings per share over here. We take this $2.80 divide by the earnings per share at that point in time. I'm sure you will get something way beyond 50. All right. But over here, it dropped a bit, but the PE ratio is still at 52.5. Super high. And now, 1 year later, the stock price dropped from $2.41 to $2. It has dropped, but the PE ratio remains high at 39.8. So remember, this stock, right, has been increasing its profits on a yearly basis. However, despite being quite affordable in the stock market, quite affordable as in you can buy the stock at $2, $2.50 and whatnot. It's very affordable. But then when it comes to the PE ratio, you're buying it at 50, 60, 70, 52.5, 39.8. Very high. Okay. And finally, over here, at the year end, $1.45. Over here, the PE ratio is at 24.4. Now, the PE ratio at this point in time seems to be a little bit more normal, simply because it has finally dropped below 30. So what's the moral of the story? The moral of the story is very simple. You can actually buy a good stock like this, whereby the fundamentals of the business is very good. However, if you happen to buy a very good stock at PE ratio like this, 50 plus, 30 plus, 40 plus, 50 plus, then you are actually almost like asking for trouble. All right. It is no wonder that the stock price, I mean to say it just dropped simply because the PE ratio is just too high. Okay. So if I go back to my slide as to when exactly do I buy my stock, you can see that I never really buy a stock whereby the PE ratio is crazily high, anything above 30, 40, or 50. So that's not what I do. Okay. So typically I tend to keep my PE ratio as low as possible. So that is actually the style, my investing style. That is actually how I approach investing. It's not just about buying good, but it's also buying when they are undervalued. Okay. So what do you do when the valuation is wrong? So at this stage over here, let's say you happen to buy a stock, let's say around here, 250. And then after that, you kind of like know the concept of PE ratio. And then you start to revalue the stock. Let's say around here somewhere, maybe $2.30. At $2.30, the PE ratio is somewhere in the 40s. It is still very high. So what do you do? So at this stage, if the PE ratio of your stock, if let's say you buy a stock not knowing about its PE ratio, and after this class, you go and recalculate the PE ratio of your stock and find that the PE ratio of your stock is above 30, like let's say 40 at today's price, and then you got a choice to make whether or not you want to keep the stock or whether you want to sell off because it's still relatively overvalued. All right. So obviously, I do not know what stock did you buy, what exactly is the PE ratio. So you do your calculation and you form your own conclusions as to that lah. All right. But if you happen to buy this stock and you buy it at let's say 260 and it drops to 220, and you have actually signed up for this webinar session, and now you know the importance of calculating the PE ratio behind the stock price, and you happen to find that the stock is now at 40 in terms of PE ratio, then you can actually consider selling off the stock. However, if you actually listen to this webinar and the stock is already now here, whereby you calculate the PE ratio, it is at 24 over here, then you can actually forget it lah. Then there's not much reason to actually sell off the stock. So the question to ask here is this: if let's say the current price of your stock is at 25, are you happy to hold on to the stock? Are you happy to add on more of your own money to invest and buy more of its stock? Or are you not so happy already? So that is actually the question that every single investor needs to ask. Okay. So that is actually the thing. So it's not just about buying the stock and keep it there. Of course, along the way, we will track the business performance of the stock, and then we have to reassess the valuation. We have to recalculate the valuation of the stock, the PE ratio, the dividend yield, so that we can actually ask ourselves, hey, this stock, it has progressed this much. Now the valuation, the PE ratio is now at 20 or 30. Should I just hold on to it, or should I just sell it off? So that is actually a question that investors should be asking on a regular basis. Okay. So the third reason is actually wrong valuation. So the first two, or should I say the second reason and the third reason, is where, these two are situations. These two are situations when the stocks, right, that you purchase has dropped in value. So which means say you buy at $1 and now the stock is at 80 cents, 70 cents, and now you are wondering what's wrong with this stock. Okay, what's wrong? Should I sell and cut loss or not? So the answer lies in checking back its fundamentals and checking back its valuation in order to make a wiser decision. Next, I'm going to talk the opposite side. Let's talk about the fun side, which is this one, this reason, whereby you buy a stock at $1 and right now it's at $3, and you're like, oh, that's great, man. I mean, you bought a stock at $1, now it has risen to $3. You're like, yes. And now the question is, should I hold on to it further, or should I just sell it off? So now, how do we actually decide on this? Let's take a look. All right. Okay, so this is actually a real life stock listed on Bursa Malaysia itself. Okay, so let's assume that you buy a stock here lah. All right, when it was under $1. All these are adjusted prices, by the way. So let's say your adjusted price, your investment cost has been adjusted to less than $1. And then it has risen all the way up here. Okay, should you sell? Actually, for this one, it is a very rare case. It has never happened before until COVID-19. So over here, whatever you do here is also right when it comes to selling, okay? When it comes to selling, anything you do here is okay. Simply because if you look at the PE ratio of the stock, it has gone well beyond 100. So you buy here, it's 134.8. You buy here, the PE ratio is 179.8. You buy here, the PE ratio is 200. 200, man. What kind of stock give you PE ratio 200? Okay. So whatever you do here, let's say you decided, okay, I have 10,000 of these stocks, and then I start to sell it off here, 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 and here. I sell it off in 4 installments. All right, 10,000 stocks, I sell 2,500 units here, 2,500 units here, another 2,500 units here, and maybe another 2,500 units here, and you just sell it off and realize the capital gains. Would that be okay? It's okay. All right. So no issues with that. The only issue is that when it drops here, people think that this is a discount. And apparently this is not a discount. As you can see, if you happen to buy a stock, and by the way, this is a good stock, it's just that the PE ratio is well beyond normal, well beyond discount. It's actually not a discount, simply because the PE ratio over here is still well above 100. You buy it at, let's say, $4, it's still, the PE ratio is still crazy. So forget it. So anything you do here, as long as you're buying here, you are not gonna make money, as proven by Google Finance. Okay. So if you happen to buy anything here, then of course, you're buying it at the wrong valuation. However, if you're buying here and you're buying somewhere here before COVID-19 and you sell it off anytime over here, then I would just like to wish you congratulations for picking a good one and selling it off at a relatively at a good price. So when would investors sell? When these things happen, when the stock that you invested in the past, the PE ratio has reached 50, 70, 80, 100, 200, that kind of crazy valuation, right? You can sell it off already. There's no point in keeping this stock and hoping that it will go. Where do you want the stock to go in terms of its PE ratio? If it's already at 100 or 200, you want the PE ratio of the stock to go to 500 or to the moon? Very unlikely, because most of this kind of increase is not exactly sustainable. So if you find that a stock, no matter how good the PE ratio is, no matter how good the fundamental is, if it's crazily overvalued, just sell. All right? Just start selling on an installment basis. Last but not least, this one is how do I say, this reason, situation number 5. Now, this one is a little bit debatable. It's very hard to say, okay? It's either you got it right or you may not get it right. So either you sell it off or you don't sell it off, it's still okay, all right? Because this one, there's no right or wrong answer to this. But anyway, let's see whether it makes sense or not. So I actually prepared a case study, and let's do a comparison whether or not we should sell our existing stock in order to fund a better investment. Let's take a look. All right. So let's say I have been investing like how I invest. All right. And then we find that, let's say in the stock market, let's say in the US stock market, okay, although this is a Bursa organized event, but I suppose today we are living in a much globalized environment whereby we can invest globally. All right. So let's assume that we have some Bursa stocks. And then we also we also do some studies on US stocks, for instance. And then we happen to find that one of our favorite tech giants, all right. So the earnings look something like this. It is a growing business. The business is actually crazily, highly profitable, like this. And then because of some external reasons, the stock price actually fall. And it fell to the extent that its PE ratio is just 10 to 15. Okay. So now we see that the fundamentals is pretty good, but then not too sure what happened. The stock price actually fall to the extent that you can grab this stock, a US tech giant, at a PE ratio of 10 to 15. And the thing is that you don't have excess cash to invest in this stock. So now, what will I do? What will you do? There are two options. Number one, keep our 5% dividend yield stocks or REITs, which are listed in Bursa Malaysia. Or B, we sell it off so that we can actually recoup some capital and invest in a US tech giant. So which of the two is actually something that you will do? All right, type in the chat box. Is it option A or is it option B? Which one would you do? Okay, so as you can see, some of you guys will say B. All right, like Izan says B, Kuwan says B, Huang says A, CS Huang says A, Albert says neither, Navid says A. Okay, so a lot of people says A, Zachariah Thomas A, YE A, Wong YT B, Pang Chiu Hyung B, Esther Ho B. So as you can see, this kind of thing, right, is very subjective. You can be right with A, and you can also be right with B. So there's no wrong. There's no right or wrong in this situation. It's just whether or not you're comfortable to make that switch or not. It's just that. So either way, you're still right. Either way, you can be right. All right. It's just what are your the percentage of your gains. It's just the difference is that only lah. All right. So that is actually what I believe. You could be right in regardless of how you choose, whether be A or be B. Okay. So if you choose to keep your dividends, that's well and fine. But if you choose to sell it off and invest in a US tech giant, then of course, for this case, you are handsomely rewarded lah. All right. Whatever capital appreciation that you get from this US tech giant will definitely outweigh the amount of the 5% dividend yields per annum that you're going to get from keeping your stock in Malaysia. So that's what I'm saying. Okay. So therefore, guys, these are the 5 reasons, major reasons of why an investor would sell off a stock. Number 1, personal reasons. Number 2, when the stock's fundamentals have deteriorated, then of course you can sell. The third one, wrong valuation. The fourth one, in order to realize massive gains because the stock that you invested had become crazily overvalued. And number 5, this is a yes and no situation, whether you should be selling your existing stock in order to actually fund better investments. But of course, it really depends on how you define what better is lah, all right? Because a lot say, I want to find a good investment. The question is, how do you define good? That is also the question, right? So with that, yes, I would like to actually spend a lot more time on Q&A session so that I can address some of your concerns when it comes to this subject. So I'm going to just pass the floor back to Shane. So Shane, all yours.
Thank you so much, Ian, for sharing with us the 5 situations when investors should sell your stocks. Okay. So if you have any questions you want to ask our speaker today, please write them at the Q&A box, not the chat box. Okay. Yeah, our chat box today is very interactive with a lot of exchanges of useful information. So thanks for participating in our chat box discussion today. So if any question, write in the Q&A box. All right. So easy for me to manage.
Okay.
So the first question is, just now when you share your portfolio, stock portfolio, there's a weightage assigned to each stock A, B, C, D until O, right? So is it based on cost or is it based on market value?
Oh, that's based on market value.
All right.
Mm-hmm.
Next question is by Muhammad Rusti. Between net profit and cash flow, which one do you prefer to use as a main indicator in selecting good companies to invest?
I use both. It's just that for this webinar session, right? Of course, I use net profit, but then I just want to share with you that it's just a summary of fundamentally good businesses lah. But if you ask me how I actually make the decision, right, it's not just about looking at net profits, it's also looking at cash flow. So you must have net profits that are growing, okay? They are positive and they are growing. So as operating cash flow, it must be positive and it must be growing. And as a dividend investor, you must also have the cash flow simply because your operating cash flow pays us the dividends. All right. So of course, there's someone in the chat box who commented that you want to throw away stocks that borrow money to pay dividends. Of course, you can do that lah. All right. Simply because what you want is consistent, recurring dividends. And the best way to actually get consistent and recurring profits and dividends is the best way to actually look at it is to actually find companies with positive and growing operating cash flows.
All right, thanks for sharing with us your perspective. Um, the next question, uh, is there any particular sector that you continually hold company shares, and why you choose this sector?
Oh, actually, I'm not sector specific one. I am more company specific. Like I said, I mean to say, when I buy companies, I only buy one type of company. So as long as you tell me that there's a certain industry whereby the company, the profits, the cash flow, the balance sheet all looks very nice, something like this, okay, I'll be more than happy to deep dive into it and study it. And if let's say it is something that I like to see, all the figures are actually good, the management is great, and there is also the management is very proactive in actually growing the business further, then of course, why not? If the valuation is right, more than happy to grab it and hold on to it for as long as possible lah.
All right, thanks, Ian. So do you believe in this buy on the rumor, sell on the news?
No.
Okay, that's a very straightforward answer.
I mean to say like that's why the whole context ma. You buy on the rumors, what kind of rumors? If it's good rumors, are you looking to buy a stock so that you can actually hope that the stock actually go from $1 to $1.50, $2 or $3? Like you go on a vertical like that. Are you buying on rumors? And then and then if let's say you are into that, then of course, and let's say you have fun doing that lah, then of course whatever I presented for 1 hour, right, doesn't make sense anymore, ma, because your aim is to go something like this, right? So, and the last thing that you want is to buy when there's a bad news and then your stock go like that, ma. So if you're always concerned, you're finding this and you're avoiding this all the time, then of course you're not doing what exactly I'm doing lah. So I don't really, so I'm not too concerned about the rumors or the news in the market. That's not my main concern lah.
All right, so you wait for until it becomes a fact, right, before you make decisions. Am I right?
A fact is more like for example, something that has already been reported in like this is fact. This is really, really facts because it's already in the annual report. So this is fact. Okay. And of course, the earnings per share is a fact. And of course, from there, you can look at the stock price and then all these things are actually based on my own transaction. So this is actually how I do things lah. All right. So I do not know about what sort of opinion. I would say that information can be separated into three categories. The first one is fact. The second one is principle. The third one is opinion. So the fact is like, let's say stock A. Stock A is a company that makes $4.5 billion. Is this a fact? It's a fact. All right. So what is the principle? The principle is to find, let's say value investing principle is to find good businesses, the businesses that are highly profitable, strong balance sheet, good management, has great economic mode, and all this kind of stuff. Buy it when they are undervalued. So that's a principle. So I use principles as well. Opinions are like, oh, The stock is actually making 4.5. I think the stock will go, I think in the next 5 years, this stock A, the profits will actually go up to 5 or 6 billion in year 2030. That one is your own opinion. Or you can say the opinion of some analysts. Or I think this stock, the profits will actually drop by half. How do you know? I don't know. So that is actually an opinion. So I put lesser weightage on opinions, more towards facts and principles. Correct.
All right, thanks, Ian.
Mhm,
The next question is by Casey Lee.
mhm.
So, if we need to liquidate some of our positions for personal reasons,
Yep.
how do you make decisions between these two? Should we sell the profitable
Mhm,
ones, the ones in green, or
mhm.
should we sell the one that is in red?
Okay. So typically we'll go through this process again. So let's assume, okay, so these are reasons. But let's look at these two. So out of the 17 stocks that I hold, I would want to see which one is my core. Like, let's say, for example, there are stocks whereby these are the best in terms of its fundamentals. It's like A plus already. So that one I won't touch. Then I go through the list. Maybe out of the 17 stocks, there are 2 or 3 stocks whereby the fundamentals is like B plus or something like that. Maybe I will throw that. Maybe I will consider selling that first versus the A plus one. So I'll go by the fundamentals first. And then the second one will be the valuation. So if let's say the stock price has dropped and I still feel that, let's say all right, let's say I know that I can replenish the stock in 1 or 2 months' time. Let's say the stock that I purchased is $1 and now it's at 70 cents. And I roughly know that, actually I don't know So this is based on speculation. Although I'm not a speculator lah. But then let's assume that there are certain stocks by you have the confidence, but you can't be so sure all right? There's nothing sure in the stock market. Maybe you just need the cash for 1 or 2 months just to do that. And then once you have the money back, you buy back your stock at 70 cents. If you're willing to do that, fine. So that could be another consideration lah. But of course, if let's say you sell a stock at 70 cents and then it goes up back to 90 cents, then it's not, then that's a very unfortunate event lah. But that's the price that you have to pay for not holding on to it. That can actually happen. But in terms of priority, I will let go the ones that are fundamentally less stronger. But that is a funny thing because when it comes to my portfolio, right, all my stocks are quite fundamentally quite there lah. So it's just a matter of keeping which one I prefer to keep and keeping and which one I should be disposing. That kind of stuff lah. Find the B plus one and throw it first lah. So that's what I will do.
All right, thanks, Ian, for addressing the question.
Yep.
The next question is by Teo. So
Yep.
he gave a scenario. So if I bought a share at the PE 10, okay,
Mhm.
and over the period, the company continues to make money and the stock price double.
Mhm.
Even though the stock price double, the P still remains at 10. So would you advise us to skip the share or sell the share or continue to accumulate?
Okay, so let's say you buy a stock, let's say at 10 ringgit, and then the earnings per share is 1 ringgit. So this gives you a PE ratio of 10, right? Then over, let's say, how many years? Let's say 5 years down the road. 5 years down the road, the earnings per share increase from 1 ringgit to 2 ringgit, and the PE ratio still remain the same at 10, correct? So which means to say the stock price has become 20 ringgit. Can you actually picture this? You're following the story, right? So at $20, I mean to say you already invested 5 years. the stock's earnings per share has doubled, so as your stock price. I don't mind keeping it lah, if you ask me. That's my take. Of course, if let's say the stock has gone from 10, the stock price 10, it has increased, but it does not increase to 20, but 15, then I will buy more. If let's say the stock price goes up to 30 and the PE ratio is now 30, the PE ratio is now 15, I'll still keep it. If the stock price is 100, then I'll sell. But then based on this scenario, whereby after 5 years later, 10 years later, the PE ratio remains the same, remains constant like 10, but then the earnings per share has increased, which means also that your capital gains, you also have sustainable capital gains along the way. Usually based on my character, I will keep.
Thanks, Ian.
Yep.
Yep. So if not for these 5 reasons, even if the stock has gained 500%, will you choose not to sell? So that's the next question.
You see, a lot of people just focus on stock price, right? Now the question is, what if, let's say, the stock that you hold on to actually grow its earnings by 500%. Now that is also another question, right? So it's like, oh, what if, let's say, you buy a stock maybe 10 years ago, the stock price is 100 ringgit. Let's say the $100 or 100 ringgit. And then the PE ratio at the time, let's say it's 20. So it's like your earnings per share is 5. Then from earning $5 per share, now it's earning 20, 50, $80 per share over the long period of time. That happens in the US a lot. That happened a lot in the US, all right? And then the stock price actually, the price actually skyrocketed. However, if you calculate the PE ratio, it still remained more or less constant, or maybe increase a little bit. Maybe last time the PE ratio is 20, now the PE ratio is 30. Will I sell? I won't sell. All right. So that is actually my take, right? So it's not just about price, it's about what is the income productivity of the stock. If let's say the income of the stock actually doubled and your stock price doubled, then it's actually increasing in tandem. However, if you are just if let's say the stock increased by 2 times, the stock price increased by 20 times, then it's not in proportion already. Then of course you can sell that one for capital gains. Because imagine this. Let's say you buy a stock at PE ratio of 20. So earnings per share 1, your stock price is 20. Now the earnings per share double from 1 to 2. But the stock price actually go from 20 to 200. So 200 divided by 2, your PE ratio is 100, sell, finish. That is your durian runto, that's your windfall. Just be happy with it. That's my take. But if let's say the stock price goes up, the earnings per share double 1 to 2, your stock price goes from 20 to 40, I don't think I will sell.
All right. Thanks, Ian, for sharing your perspective. The next question is by Chang. Now, usually by the time the company fundamental turns bad, the share price has already dropped a lot. Okay, it could have plunged already. All right. So how do we mitigate this kind of situation?
Good question. The answer is, if you ask me, right, I won't have a clear-cut answer. Because if you, let's say, for example, the first sight of bad news, you already jabut, you already like, oh, I don't want this stock already. Let's throw it away. Then that's not what I do also. Okay. Usually I don't really have a a way to, I don't really have the best way to actually mitigate all these kind of things. Simply because I tend to buy very slow and I keep whatever I own also very slow, right? So the thing is that, okay lah, you can say that one of my weaknesses in terms of building a portfolio, right, is that there could be some stocks that might actually turn out to be like what I'm now sharing with you on the screen, like A Berhad like that. Can it happen? It might, but when will it happen? I don't know. Okay, but how often does this happen? Not very often also lah. Okay, maybe out of um although I'm holding on to 17 stocks that not very often lah. Not very often I have that kind of thing. Maybe less than 10%. Out of 10, nine will continue to actually give me nine will actually continue to generate increasing or growing profits or growing cash flow like usual lah. Okay. When they are doing that on a consistent basis, they continue to do that on a consistent basis. Maybe only one out of 10 actually fell out lah. So that is actually an investment risk lah. Okay. So because of that, um, maybe because of that, I tend to actually diversify it across so many stocks. But do mind that it's not on day one, I have 17 stocks. It doesn't work like, okay, today I'm interested to invest. Therefore, this is my capital. Let's say 100,000. I'm going to split it into 10, 20 stocks like how Ian did. No, it doesn't work that way. It doesn't work that way. This portfolio is actually built over years. So the diversification happened over time. So I build it over time like that. Okay. So I would say diversification is actually one way to actually mitigate the losses. Or you can think of it like running a bank. All right. I like to see myself like a banker, like a mortgage officer. So all these stocks are like my potential borrowers, right? So these are my borrowers, and I'm the banker. So my job as the banker is to check their credit report. So I find that whenever they give me a financial statement like this, I'm okay. So it has actually passed my credit assessment. So I find them to be credit worthy, right? Now, with that being said, all right, so I will diversify my borrowings into multiple borrowers. And I hope that they all pay me lah. They are very good paymaster that pay me my dividends. Just like how borrowers actually continue to service their mortgages or their car loans or whatever loans that they owe to the bank. However, there will be a small percentage of borrowers, right, that will give me a little bit of trouble. Maybe their finances are not that good and they kind of like slip out lah in terms of their financial performance. So the bank calls it non-performing loan ratio. I call it non-investment performance ratio lah. So in that sense, as long as my credit assessment is right, I can actually reduce all these kind of non-performing investments by a lot. So that is how I mitigate lah. Prevention is better than when it happens, what to do lah. So that's my take on this lah. Hopefully it's helpful.
Yep. I think typically when the bad news happen, I think it depends on how well you understand about the company and how well you understand about the industry. So if you are an industry insider, I mean, you work in the industry, so you know the industry very well. So you could have spotted the change in wind, right? Even without the financial results shown in the quarterly report, you would have easily made a better investment decisions, whether to sell or to hold before the quarterly result is out. So that's why I think I echo what Warren Buffett said, right? No, invest within our circle of competence, because if you invest within the industry where you're really knowledgeable about, then you'll be able to make informed decisions about your investment holding, without waiting for, maybe 3 consecutive quarterly bad results for you to arrive at decisions that, this company the fundamental has really turned sour. So that's
Mm,
my view lah.
right, right.
So typically, how do you classify that? Uh, when the company turn bad lah, is it you based on one quarterly result, two quarter result, or three quarter result? So there's a follow up question by Chang.
No, no, maybe a few years. Give it a few years to actually have a look. So
A
it's
few
not
years, wouldn't that be a bit too long?
no lah. I mean to say it depends on that's why I mean to say I always view stocks like okay lah, stocks is a bit like dating lah. It's like it's like whenever you buy a stock, it's a bit like marriage already lah. So it doesn't mean that your wife has a few pimples on your has a few pimples here, a few pimples there, and then you start selling your wife, right? So it's not that kind of thing. Or you see the first sign of trouble, interest rate hike. Oh, let's sell off all my REITs. Oh, interest rate gonna go down. Let's find something that is actually gonna be beneficial to that stock. Uh no lah. I mean, I didn't do that lah. So which means to say the whole idea is to build a portfolio. It's an all-weather portfolio lah that can withstand interest rate hike, interest rate fall, ringgit goes up, ringgit comes down. Doesn't matter who is actually leading this country. Doesn't matter lah. It's supposed to be an all-weather portfolio whereby it can withstand and do business and be profitable in almost every single condition. So that is actually how I built my portfolio. So some people say bad news, interest rate gonna go up, bad news. So okay, I'm gonna just give you an illustration. Like let's say you see that interest rate go up is a bad news. For example, just for example, some people say, oh, interest rate go up. Which are the stocks that are gonna benefit from this interest rate hike? Then you'll go and buy that stock. So the way I built my portfolio is such that okay, since I'm already going to accumulate, why don't I buy both? I couldn't predict where interest rate where interest rate or where ringgit is going to go. Why don't I buy something like, okay, some that will benefit when interest rate goes up, some that will benefit when interest rate comes down, some that will benefit when ringgit goes up, some ringgit comes real lah. You have this kind of portfolio, doesn't matter what happens already lah. Because your portfolio is there already. You just hang on to it and just be happy with it and collect your dividends and just live on lah. Less pressure lah. Less pressure lah because you're not gonna wake up in the middle of night and start thinking through the whole scenario. Oh, what happened when this political situation? What happened? Oh, there's a new update towards this political situation. This political party is gonna win. So which sector is gonna benefit when this party actually goes up and become the leader of this country or leader of the world? In fact, doesn't really concern me lah.
Okay,
Yeah.
understand. Understand. So you are the type of investor who can tolerate company with a few bad quarters or a few bad financial years lah. So long that you think that is a fundamentally good business, you will stay with them throughout the bad years.
Yeah, yeah. You can say that lah. It's like my wife lah. Or your wife lah.
You have
Like
17 wives
Papa.
now, Ian.
Huh?
You're very greedy.
You might have more.
um, uh, Eugene Wong would like to ask, do you use discounted cash flow to value your companies? And in what situation or sectors is DCF not suitable or do you have any disadvantages on the discounting cash flow models?
Okay, DCF stands for discounted. So the first question is what is the basis of your discount, right? So you want to discount the future cash flow. So what is your discount? So you have to discount. What is the value of my money received in year 2025 or year 2026 and year 2027? How do you actually put a discount? The question is, I don't know. And I don't know. maybe I put one figure, Shane will put one figure, maybe Eugene will put another figure. So everyone will put their own individual figure. And when you put that kind of figure, right, everybody will everybody right will actually have a very different will come out to a very different conclusion as to what kind of figure you will actually get, because the discount rate that you use is going to be very different. Another thing that when you use discounted cash flow, right, you're going to project your future cash flow. And of course, when you buy a stock, you want the business to continue to grow. So the question is, what then will be your growth rate? 3%, 4%, 5%, 6%? And what is your basis for that 3, 4, 5, 6%? Or even 10%? What is your basis for that 10%? Who give you the figure? Where do you plug it from? So that is actually an opinion already. So now you have two assumptions that you need to make, the two opinions. One, your discount rate is an opinion because how do you know? The second one is your growth rate. Where do you plug it from? Everyone will come up with their own figure. So again, we can have the same theory, but two different users, you will get very two different intrinsic value at the end of the day. And that will actually impact how you will invest. So for myself, I don't use discounted cash flow because to me, as long as I can find something like this I can find some this and buy, that's good enough already. So I don't really need to find discounted cash flow lah. So that is actually not in my to-do list lah, or not in my criteria, because I find it to be, I mean to say the concept is good, don't get me wrong. It's just that when it comes to computing it, I figure out that there's a lot of assumptions that I need to make in order to come up with the final figure. And on top of that, there are certain sectors that you cannot actually use this. The first one is bank, because why? Very simple reason. I put money into the bank, I withdraw my money out from the bank. It's my own thing, it's the customer's issue, not the bank's issue, right? So let's say a bank reported negative cash flow for a certain year, and that is simply because its customers are just so happen to withdraw more money out than they deposit in. That is not very reflective of the company's fundamentals in the first place. So I find that it doesn't make sense to use DCF on banks lah.
Yep.
So I would say that is the primary sector that I don't think we should be using DCF on that sector.
Yeah, I think some more we have to project, growth for how many years, like how many years will this business stay in business, right? So there are a lot of assumptions that we need to decide when it comes to using this kind of forecasting model.
Yep. Correct.
I've seen a couple of similar questions, so I'll just sum it up.
Yep.
Richie mentioned this principle is that, this principle is that not hold more than 15% weightage in any portfolio. So let's say if an individual stock in a portfolio has already surged and it has surged like multi-baggers, so would you readjust your portfolio by taking off some profits off the table so that this stock may not stand up too big of a weightage in your portfolio? Let's say the fundamental is still very strong and PE of the company is still at 10. All right. It's reasonable valuation. Would you sell this individual stock?
No, I won't sell it just to rebalance my portfolio to a certain weightage.
So you let it become
I'll let
okay. So you'll keep the stock and
I'll
like it
keep
have
it. I'll keep.
You'll keep lah, okay. Understand.
I'll just keep. Yes.
Okay.
I believe
understand.
I will keep. I won't actually sell just because I want to rebalance. Yep.
All right.
So
okay, the next question by Sam Nair is, what if the company makes good profit, but they do not declare dividends? Would you want to hold on to the stock? And if yes, it's for how long?
in Malaysia, if a company can consistently generate positive operating cash flow and it is highly profitable, it is very, very normal for stocks in Malaysia to pay out dividends, whether more or less, but it cannot be zero. But if let's say a company that is highly profitable, super profitable, and it pays zero dividends in Malaysia, then that number one is already an abnormality for the context of investing in Malaysia. Number two, if let's say really there's such a stock, so the next thing is where does the company going to, what will the company do when it comes to allocating its operating cash flow? Where does it go? All right, does it go into capex? Does it go into business acquisition? Does it go into share buybacks? Does it go into paying off its debt? Or does it just keep the money in the bank? So you have to find out what the company is going to do with this operating cash flow. That is something more deep lah, and that is something that I will actually study very in depth as an investor. So to your question, if a company is profitable but does not pay dividends, I tend to avoid it because it's an abnormality. Because in Malaysia, profits after you pay off corporate tax, all right, you pay, and then they pay out dividends to shareholders, it's single tier dividends. Why not, right? So the thing is that the more normal kind of you don't need to go with that kind of company. Go with the ones which is more normal. All right. You don't need to go with that one outlier. But for most Malaysia, just stick to the one with which is profitable and pays out dividends. The ones that don't pay dividend, just avoid it. And will not hold it because we'll never get into it in the first place.
All right. Last question.
Yep.
Would you share with us some strategies investor can use to overcome, fear of missing out and the fear of loss?
The first one is to come for this webinar like this. But again, it depends on who is the speaker because I believe Shane has featured a lot of very diverse speaker. So you need to know who are the speakers. Like for example, how do they invest? What is their portfolio like? How do they actually come to their own conclusion as to what a good stock is? How do they even define a good stock? How do they come up with the right price or right valuation to actually buy the stock or sell the stock? So what is their methodology? So from there, you can compare notes and see for yourself which one is actually more suitable for you. So let's say just now, you have actually assessed what kind of stocks, the characteristics that I buy, this kind of company. And then let's say you say, I like Ian, this is not really my thing. Then okay, then you find the next guru, then you find the next guy that you think that will resonate you much better, right? So that is actually the first thing. Find the good teacher. Okay. So if you think that, hey, whatever, if you think that, okay, whatever Ian says today, this is how he does things. Profitable business. Okay, just don't buy whatever that's not profitable. PE ratio. Make sure that you don't go excessive. Don't go gila on your PE ratio. Make sure it's on the lower side. Okay. And then your dividend yields about 5 to 6%. And you think that this is actually quite okay. Then you, since you have an idea, actually something that you want to, then you learn. Then you find maybe another 2 or 3 more people or who is actually doing the same thing. And then you kind of like study their methods and see whether it resonates with you or not. I believe that from there, from knowing what you know, and from knowing what you need from education, let's say education. From education and from knowing what you need to know, you know what you want. I was finding the word. You know what you want, you know how you want to build your portfolio, you know your action plan, what to buy, why you buy it, when you want to buy it, how much you want to buy it, how you want to construct your portfolio. You got all these things figured out first before you invest. It should reduce your FOMO, your fear and greed, and all this kind of stuff. Of course, there are people who actually buy, let's say here lah, they buy because whoa, stock going up like that. I feel I miss out on this. What if? I mean to say at this stage, what I can say is that after investing for quite a number of years already, although I'm still young, but quite extensive. Okay. So throughout my years of investing, you will definitely find opportunities, good or bad market, you can find. There's no one deal of there's no deal of the century. There's no if you miss this wave, if you miss this boat, there's no more boat already. It's like, ayo, no more boat already. The boat has left. The boat has left the port already. Ayo, what do I do next? Just wait for the next boat lah. It's like surfing, you know? It's like surfing. You miss the wave, catch the next wave. No issues. If you miss an opportunity, fine, let it go. Doesn't matter. All right. Don't need to actually like cry over this kind of spill milk, because better opportunities are always here to come. It will come. It has come in the past. It will come in the present. It will definitely come in the future. So as long as you know what you need to know, you know, what exactly is it's like, how do I say, there's an analogy on baseball. It's like, you know, baseball, right? You got 3 chances to hit, right? But in baseball, you got 3 chances to hit. But in investing, right, you can have as many chances as you want. Just make sure that as long as you are quite confident, you're quite sure of that one, you can just swing. Nobody is going to take you off the pitch until the end of our life lah. Until the end of our life, nobody is going to take you off the pitch lah. So don't need to be too concerned about this vertical up and that vertical down lah. No need lah. And by the way, just one last thing. Really lah, if you build a portfolio that is more than 10 stocks, 15, 20 stocks, and you hold on to this like this, right? The ups and downs, whatever market condition, unless everything crash, but then a bit hard lor. So you over time you should be less sensitive over price movements.
Yep, actually there's one question from the audience to ask you, how do you manage 2008 financial crisis? But I'm not sure if you have started investing 2008.
2008 no, not
yet, right?
Yet, but I would say that was, I mean to say, I kind of like I was aware of it because I read about it, and I was still very new towards educating myself in terms of finance and investing at that point in time lah. So I get to witness lah, and maybe that helped a lot during COVID-19 lah, because I was educated about all this kind of stuff lah.
All right.
Yeah.
Thank you so much, Ian.
No problem.
So we have run out of time. In fact, we have overrun the session for a little bit. So thank you so much, Ian, for doing this session for us, and also for the very interactive Q&A sessions. We have a lot of engaging response in the chat box and also in the Q&A. But unfortunately, I've run out of time, and there are still like 30 over questions on my screen. So maybe you can ask Ian to come back to do another sharing. So if you have any more questions, you can ask him in the next session. All right. So ladies and gentlemen, you just heard from the co-founder of Dividend Board, who is Mr. Ian Tai. Thank you so much, Ian.
Right. Thank you so much, Shane. Hope you guys enjoy this session.